Hey everyone, it's Zach back with a new mortgage video. Hope you all had a happy weekend. If this is your first time seeing one of my videos, welcome to my channel. If you're a returning viewer, welcome back, where I'll try to demystify all things mortgage related. If you find this content helpful, please like and subscribe. So on today's market update, I want to really dive into inflation and where I see it going, what specifically within inflation is being affected by tariffs and expected to be affected by tariffs, and what is not. It's a pretty data light week, but I'll talk about a few things that could move the needle in terms of scheduled reports. So last week was a very data heavy week in terms of inflation specific data. So on Tuesday, we had consumer price index, which is kind of the first big holistic report that comes out each month. Wednesday, we had producer price index, and then Thursday, we had retail sales. So what last week showed, I think, is that inflation is still kind of a tricky report to read when it comes to the direction of mortgage rates following data. Historically, you see higher than expected inflation, that hurts mortgage rates, lower than expected inflation, good for mortgage rates. That's not necessarily happening right now. So Tuesday, the first big report, consumer price index, came in lower than expected for the core reading. The headline reading came in as expected, and yet mortgage rates went up. So why is that? I think it's the market trying to parse out what is the most relevant pieces of inflation within the overall number and reacting to that. I think this is a good opportunity to talk about what parts of inflation are affected by tariffs and what parts are not. Broadly speaking, it's service-based industries that are not directly affected by tariffs. So things like healthcare services, financial services, shelter, which I'll dive into especially, those are not directly affected by tariffs, though there's certainly ways tariffs can trickle down into influencing these reports. But what's going to be directly affected by tariffs are industries that involve manufacturing and shipping overseas. So used and new cars, toys, any kind of clothing, apparel, devices like your computers, smartphones, any kind of durable goods should be directly affected by tariffs. And it's unfair to say that this recent CPI report showed all of those industries going up and all the industries not affected by tariffs going down. That's why it's a complex situation. We saw an uptick in some tariff-influenced industries like apparel, but we saw a decline in things like used and new cars. The big thing that I think is worth keeping an eye on now is shelter costs. I've been, in the time I've been doing this YouTube channel, I've almost always been talking about shelter. I've been focused less on that recently, but I think it's worth coming back to. Shelter is still the component of overall inflation that is keeping it elevated by far the most. Shelter has been declining. For those that haven't seen me talk about this is a number that follows rents offered. Rents offered peaked in 2022, and shelter peaked in early 2023, and both have been declining. Now, rents offered has basically stayed flat for a while. And while shelter has certainly come down from its peak, it's starting to kind of flatten. It's declining, but extremely slowly. And what that could mean is that no matter what happens with tariffs, even if we see an uptick in some of these durable goods, and then the reaction is, well, let's reverse them, pull back these tariffs so we don't see this kind of inflation. That may not even matter if shelter stays elevated, which it's looking like it will. And it's worth mentioning that the shelter metric is always going to lag behind the actual events. So even if we did have, let's say, another pandemic or something, that wouldn't show up in the shelter reading for probably at least 6 months. And that's one of the reasons a lot of people will criticize that number, which I think some of that's warranted, but It is still a metric that's very important for the Federal Reserve and is extremely relevant, therefore, for mortgage rates. So with that said, what does this all mean? If shelter continues to decline the same way it has been, let's say 0.05% year over year every month, we're not going to get till even 3% for over a year, about a year and a half. And there's no way we can get to the 2% barring crazy deflation in every other sector without shelter coming down to probably 2.5%. So what that means is we're going to be above the 2% overall inflation number for the foreseeable future. And that doesn't necessarily mean there's no chance the Fed is going to cut rates. But what I think it does mean is it's going to take a real substantial weakening in the job market. You could argue there's been a little weakening, but I don't think nearly enough to warrant an immediate rate cut. And the Fed has said multiple times, Jerome Powell specifically, that as long as the job market stays in the same range it's been, they're going to wait and see how things play out with tariffs, which as of now, Trump has given the new deadline to August to finalize tariffs. I still think that we are going to be looking at a moving target for the time being. And what's very clear based on last week is that inflation specifically is going to be a very tricky data point to dissect. I think jobs data has proven to be much more easily deciphered. Not a whole lot of big job reports or inflation reports this week. On Friday, there's a report called durable goods. And notably, durable goods orders went up dramatically last month. That was looked upon as probably front loading. This month, they are projected to decline pretty substantially. And depending on how that comes in, that could be a major market mover, since that is the category of items that tariffs affect the most dramatically. So if you have any questions or comments, shoot them below, or feel free to call, text, or email me. But thanks for tuning into this market update, and I will see you next time.